Welcome to The Explainer. Today, we're pulling back the curtain on one of the most high-stakes, behind-the-scenes financial battles that happens in boardrooms literally all over the world. Just imagine this, right? A company has just closed out an absolutely incredible year. The spreadsheets are green, profits are rolling in, and there is a massive pile of cash just sitting on the table. But what happens next isn't actually a celebration. It's the beginning of a massive tug-of-war.
Okay, let's dive into this, because it's the ultimate question in corporate finance. Your company just made millions. So, do you hoard that money to reinvest and grow the business, or do you hand it out to the people who own the stock, the shareholders? Every single decision a board of directors makes about this cash sends ripples through the entire stock market. This isn't just a math problem, you guys. It's about psychology, strategy, and corporate survival.
So here's our roadmap for today. We're going to start with the great dividend dilemma, look at what drives dividend policy, explore the quest for stability, examine dividends as the leftovers, and wrap up with how companies actually distribute cash.
Section 1. The Great Dividend Dilemma, the firm versus the shareholder.
All right, here's exactly why this tug-of-war exists. First, look at the firm side of things. Companies need cash to grow, right? If they have a great idea for a new product, what the finance folks call a positive net present value project, they want to fund it. Now, if they use their own retained earnings, it's virtually free. But if they give that money to you and then have to go crawling to the bank or issue new stock to fund their project, they get hit with hefty external costs, like flotation fees. So inherently, the firm wants to keep the cash. But then contrast that with the shareholders. Investors are diverse: retail investors, pension funds, retirees. Because capital markets aren't perfect, and let's face it, the future is always uncertain, a lot of investors demand that cash right now. They want a bird in the hand. For many, that regular dividend income is essential to just pay their living expenses. And depending on their tax bracket, they might heavily prefer getting cash today over the mere promise of future stock price growth.
Section 2. What drives dividend policy? Weighing the rope.
So a board has to juggle a lot of factors all at once. The absolute biggest one? Where the firm is in its life cycle. A young, rapidly growing tech startup has tons of investment opportunities. They desperately need cash, so they usually have a zero or very low payout ratio. But a mature utility company? They probably don't have as many high-growth projects available, so they distribute most of their earnings. They also have to look at business risk. If sales are incredibly unpredictable, they're going to conserve cash. If they have a mountain of debt, they might actually face legal or liquidity constraints that completely prevent them from paying dividends. And there are even control issues. I mean, if they pay out all their cash, they might have to issue new shares to raise capital later. That dilutes the voting power of the existing management and makes them a prime target for a hostile takeover.
Now, what's really fascinating here is how companies essentially self-select their shareholders. It's known as the clientele effect. If a company decides to pay high, regular dividends, they naturally attract a specific clientele, like retirees who need steady income. If a company pays zero dividends and reinvests everything, they attract investors hunting for capital gains. The huge danger for a company is abruptly changing their policy, because doing so completely alienates their current clientele and can trigger a massive stock sell-off.
Section 3. The quest for stability, the psychology of the payout.
Notice how a company's earnings can bounce up and down wildly from year to year. But look at the dividends. They are incredibly stable, only steadily rising over time. Now compare that to a stepladder approach. The dividend stays perfectly flat for years, even as earnings rise, until the company is absolutely 100% certain they can maintain a higher payout, and then, boom, they bump it up to the next step. Companies purposefully smooth out their dividends because it acts as a massive signal of strength and certainty to an anxious market. It reassures investors that the long-term prospects are rock solid, regardless of temporary economic bumps.
Now contrast those stable approaches with a constant payout ratio. Here, the firm just says we're going to pay exactly 30% of our earnings every year, no matter what. Mathematically, very logical, but practically, investors generally hate this. Because earnings fluctuate, the dividend fluctuates directly with it. For an investor relying on that money to pay their monthly bills, this kind of uncertainty is just a nightmare.
So, the crucial point here is summarized perfectly by the legendary researcher John Lintner. Dividends are sticky. Once a company raises its dividend, the market expects it to stay there forever. Executives are literally terrified of cutting a dividend because it is the loudest possible signal you can send that the company is in severe financial trouble. If they cut the dividend, you can almost guarantee the stock price is going to plummet.
And because of that intense fear, corporate boards focus on one primary goal. They pick a long-term target payout ratio, and they move toward it very, very gradually. They refuse to make knee-jerk reactions to a surprisingly great quarter or a terrible one. They basically act as a financial shock absorber for their shareholders.
Section 4. Dividends as the leftovers, the residual approach.
In financial theory, this is known as the residual payment approach. The logic here is simple, but kind of harsh. Your company's primary job is to grow your wealth, right? Therefore, they should take their earnings, look at every single profitable project they could possibly invest in, and fund those projects first. If, and only if, there's money left over after exhausting every good idea, they pay you a dividend. Dividends are literally just the leftovers.
And this brilliantly illustrates exactly how the math plays out. Let's just look at year 1. The firm earns $200. Their investment budget for new projects is $182. And based on their capital structure, the equity portion of that, the cash they need to fund themselves, is $91. So what's the dividend? It's just the earnings of $200 minus the equity they need, which is $91. The residual, the leftover, is $109. That is what the shareholders get. Now, while this maximizes the firm's growth efficiency by minimizing expensive borrowing, you can clearly see how it creates fluctuating dividends from year to year, which we already know investors dislike. Because of that, most sensible firms use a more smooth residual approach in reality.
Section 5. How companies distribute cash. The final toolkit. So the most famous method is, of course, the classic cash dividend. It's incredibly straightforward. The company wires the money directly to your brokerage account. But it's really important to remember that when a cash dividend is paid, the firm's total assets and net worth instantly drop. The pie actually shrinks. In fact, on the day the stock goes ex-dividend, the market price of the share usually drops by the exact amount of the dividend they just distributed.
A really fascinating alternative is issuing bonus shares. This is huge for growth companies that want to reward shareholders but just cannot afford to part with their precious cash. They give existing shareholders new shares for free. But here's the catch. It's purely an accounting trick. It recapitalizes the reserves, but the firm's total net worth doesn't actually change. Your proportional ownership doesn't change either. The company just sliced the existing pie into more, slightly smaller pieces. This often brings the share price down to a much more accessible range for retail investors.
Then we have the modern heavy hitter, the share buyback. If a company is suddenly flush with excess cash, but they know they can't maintain that massive payout forever, they avoid the whole sticky dividend trap by simply buying their own shares on the open market and destroying them. By shrinking the total supply of shares, the slice of the pie for the remaining investors gets bigger, earnings per share automatically increases, and it sends a really powerful signal to the market that management believes their own stock is deeply undervalued.
Finally, for the ultimate compounding machine, many companies offer what are called DRIPs, dividend reinvestment plans. Highly popular in America and Europe, this setup allows you to automatically take your cash dividend and immediately use it to buy more fractional shares of the company. Sometimes you even get a discount, and usually there is zero brokerage fees. It's a fantastic way for investors to grow their stake entirely on autopilot.
And that brings us full circle. You've seen the internal logic, the market psychology, and the absolute tug of war that dictates every single penny of profit a company makes. You understand why some hoard it and why some pay it out. So, think about your own portfolio for a second. Knowing the profound corporate strategies at play, if your absolute favorite company just posted record profits today, what would you demand from them? Immediate cash, the optical boost of bonus shares, or the value-condensing power of a share buyback? Think about it. It's your money after all. Thanks for joining us on this explainer, and we'll see you next time.